Hi everyone and welcome. Thank you for joining us today. I'm Humza, one of the investment consultants here at CityRise, and I'm here with Matthew, our head of performance. Today, we're going to talk about something that I genuinely wish someone had sat me down and talked me through before I looked at my first property. We're calling it red flags and green flags.
Yeah, glad to be here. And honestly, it's a conversation that you and the other consultants have almost on a weekly basis. And those conversations are obviously one-to-one. So it's nice to do it in this kind of environment where our viewers can get a little bit of an insight as to what we think are the red flags and green flags.
Absolutely. So before we dive in, Matthew, give everyone the quick version. Why does this topic matter right now?
A couple of reasons, Humza. The market shifted. Interest rates are fluctuating all the time. Regulations change all the time. Stock levels go up and down. And I suppose what looked to be a good deal 2 or 3 years ago, is it necessarily a good deal now? Problem is, I think, that there is a lot of advice floating about online, even webinars, like this. And it's from people who are maybe selling educational courses or pushing certain deals as good for particular reasons, and even old content, if something was written 2 or 3 years ago, is it relevant to today's market? What we want to do, and I think what the purpose of what we're trying to do today is outline a good framework and not advise people or give people hype or give them doom, give them a framework which is real and which they can apply to any deal that they look at.
And just so people know what they're getting, we're going to walk through 4 areas: the location, the deal itself, the property, and the developer. And then we're going to talk about how to pick an agency that actually works for you.
Yep.
Does that sound good?
Sounds good. Quick one though. We will be honest about the red flags, even when they apply to our industry, because that's what makes it useful for everybody that's here with us today.
Absolutely. Okay, so let's start where most investors start: location. When you look at an area, what's the first green flag that you look for?
Honestly, I will always look for infrastructure investment, and specifically infrastructure that is already committed, not promised. And what I mean by that is there a confirmed transport link or regeneration scheme with planning approved? Has a major employer look to break ground, on a new office building in a new location? Anything that you can verify on a council website or in a published plan, that's a green flag, because it's not speculation. It's value that's been built whether you buy or not.
Yeah. Can you give us an example of that?
Think about places where a new train line has been put in, or stick with that one. So think about somewhere where a new train line has been put in and it's cut commute time by 15 or 20 minutes. The moment that's confirmed, the catchment changes. People who couldn't live in that area before for various reasons, they suddenly can. And that obviously means that rental demand jumps up before the train line's even open.
Yeah, makes sense. So that's the green. What about the red flags? Because I think this is where a lot of people get caught out. They fall in love with a postcode.
Yeah. For me, 3 big red flags on location. So firstly, and this one's counterintuitive, but extremely high advertised yields in places that you've never heard of. So if somebody's offering, when I say somebody, an agent or a developer's offering a 10, 11, 12% yield in a town that you couldn't place on a map, and it sounds too good to be true, probably is. Second red flag for me, single employer towns. So if one factory or one big office block goes, the whole rental market collapses pretty much overnight, and we've seen it. So diversification of local economy matters for me as much as the property itself. Thirdly, areas with declining populations. You can find this data publicly. If people are leaving faster than what they're arriving, then there's a structural problem that no amount of refurb will fix.
Yeah, makes sense. And quick one, what about up and coming areas? Everyone always says, buy where the area is changing. Is this real advice or is it just a cliche?
Definitely real, but comes with a caveat. So up and coming, for me, only matters if you can see evidence of change. So is the cranes in the sky? Leeds is a great example at the moment. You drive into Leeds and it's just crane. So evidence, that things happening here. Is a new independent business opening? Are schools improving? Are Ofsted ratings going up and improving over a period of time? Are planning applications being granted? If the only evidence that an area is up and coming is that an agent is telling you, that's not evidence, that's just marketing.
What about? So, green flags: committed infrastructure, diverse economy, growing population, visible change. Red flags: suspiciously high yields, single employer reliance, declining population. Anything else before we move on?
One more green flag worth mention, I think, is rental demand depth. So don't just think, can you let it? But how many tenants, how many people are actually wanting this type of property in that particular area? If the only tenant pool is students and you're relying on university enrolments and those enrolments drop, which, we're seeing up and down the country, then you're exposed. So best thing is multiple tenant types. So young professionals, families, key workers, if you can get properties that suit those kind of people and are in those kind of areas, then that for me is resilience in the marketplace.
Right. So let's say a location stacks up and the investor's now looking at the deal itself.
Yeah.
What's the first thing you do when you see a deal on paper?
So might sound obvious, but compare it to the local market. And again, I'll say it sounds obvious, but you'd be amazed at sort of how many people don't do it. So I want to know what similar properties on the same street or in the same building or in the same postcode are actually selling for. Not what they're listed at, what are they sold for. That's public information. We can go onto the land registry, anybody can go onto the land registry and see that information. Then what I'll look at is what they're renting for. Cross-check that against, maybe 3 or 4 different sources, not just one portal. Let's look at different places to back up that evidence.
So research is key, you'd say?
Absolutely, yeah.
And in them numbers, what's a green flag?
When the purchase price sits at or slightly below comparable sold prices, and the projected rent sits at or slightly below achievable market rents, got to be conservative on both sides, and it means that the deal works even if the market wobbles a little bit, which inevitably it will.
Yeah, absolutely. So if I'm being shown a glossy projection, what should I be looking for?
3 things, and this might be a theme through this webinar of, I think I'm going to summarise things in 3 or 4 ways. So for this one, is the rent realistic or is it completely top of the market range? So ask for evidence, ask for comparable lets in the last 6 months, not aspirational figures. What are the assumed costs? So leasehold, flats and apartments are a good example of this. There's service charges, there's ground rents, there's maintenance charges. Void periods, is something that people don't often think about. And I think agents are very good at telling people it'll rent all the time. But let's be realistic, the chances of moving a tenant in an hour, after the tenant moves out is pretty slim. So I think if voids are modelled at 0, that's a bit of a fantasy. And we've got to account for maybe 3 to 5% is realistic depending on the area. And then thirdly, is the projection gross or is it net? Gross yield sounds great until you take 15-20% off real costs. We're aware obviously of an example at the moment, aren't we? We're marketing a development in Leeds and we've got it marketed at just under a 7% yield, and one of our competitors also in Leeds selling the same units, they've got it marketed, I think it was 14% yield. So look into these things, be careful what's net, what's gross.
Yeah, again, if it looks too good to be true, usually it
probably is.
So that shift on point 3 is fully valid and takes us nicely into the red flags.
Mm-hmm.
What makes you say absolutely not when you see a deal?
Top of the list for me is assured rental guarantees that are baked into a purchase price, and I'll explain that a little bit for you. So you're paying a premium to a developer for guaranteed rent for a couple of years, which sounds great, it's safe, but what actually happens is the developer has inflated the purchase price. to account for the value of those 2 years guaranteed rents. And at the end of the 2 years, the rent drops to market rate. You're sitting on an asset worth less than what you paid for. So walk away, in my opinion. Guaranteed rents, walk away.
So the guarantee is essentially you paying yourself back with your own money.
Exactly what it is, Humza.
Next red flag.
Vague or moving numbers is a big one for me. If you ask 3 times, what service charge is, and you get 3 different answers, or that'll be confirmed at completion, or check with the solicitors, it's a red flag for me. Real deals have real numbers, as you'll know, from the stuff that we market and that we advise to our investors. You should be able to model a worst case scenario before you commit, and that requires real hard figures.
Yeah, absolutely. And quick personal one, and I think it's good for the viewers that would be they're a bit on the apprehensive side. As yourself, you're a bit risk averse. So do you have a rule of thumb that you actually use?
Yeah. And I'd just like to point out, second webinar and second time that my risk averse nature has been mentioned. But it's true. So I'll always sort of ask myself, if I had to sell this property in 18 months' time, am I going to be able to get my money back? If the answers are confident yes, based on the comparable sold prices, I'll stress that again, the sold prices, not listing prices, not projections, then the underlying asset is solid. If the answer involves hopefully, or we think it will, then it's not a deal. It's a gamble.
So always backed by hard figures.
100%.
So location's clean, numbers work. Now we're looking at the actual building. What changes when you're looking at off-plan versus completed?
Okay, so off-plan is probably where the biggest red flags live. And we don't mind saying that, but I think if the advice is right and the right information is presented, then kind of counteracts these. But you're buying something that doesn't exist yet, which means everything depends on the developer delivering what they promised on time to the quality, which they've assured us and the investor that it's going to be. So the question, I suppose, stops being, is it a good property? And it becomes, can this developer be trusted?
Yeah, and it's a question that we have a lot. So here at CityRise, how do we check a developer? Because they've all got really nice websites.
Yep. Everyone's got a nice website these days. Anyone that uses, ChatGPT or similar things, you can go on and create a really nice website in a few minutes. Yeah. So 4 checks for us. So going back to these summarising in 3s and 4s, I'm going to go 4 with this one. So first of all, have the developer delivered completed schemes? Have they got a track record behind them? So we're not talking planning permission here. We're not talking things under construction. We're looking at things that are actually finished. Residents living there, the blocks, you can actually see them with your own eyes. Secondly, what do the residents say 12 months on? So for me, this is the real evidence. The people that are living there, have they enjoyed it? And I think the best thing to look at, are they renewing their tenancies after they've been there 12 months? Are they wanting to stay there? That's a really, really big one for me. And finally, probably say, what's their financial position? It says a lot about someone, doesn't give it all, but says a lot. Company's House is a great place to go. Their filings are public. You can see whether the development company has assets, whether directors have had previous companies dissolved. I'll add one more in, actually. I think I said 4. Did I say 4? Yeah, I'll add one more in then. The developer themselves, are they local to the region? I'll expand on that a little bit. So developers who pop up in a marketplace, build one scheme and disappear, are a very different risk profile to someone who's been operating in the same city for, say, 10 years. If we look at Mike, our head of developments, he does a fantastic job, for our investors by doing all the due diligence, with developers and developments, before we get them. So we do actually have a webinar where we go over what we look at in developments, which goes all over the green flags and the red flags. We won't bring a development, to market until we've seen those, and there will be a link somewhere around here where you can go and have a look at that webinar. Yeah. So do check that out.
Absolutely. So just quickly, as you've touched on, obviously Mike and the developments team do all their due diligence. Would the information that you've said that the public can see. Is that hard to find?
Ask me that again, sorry.
So the information, company's house filings, all the comparable information, is that hard to find for an investor?
I don't think so. You can go on the land registry. That always gives sold prices. You can jump onto various portals. We're not plugging any, so I won't mention them, but you can jump on the portals and see what things are sold for or rented for. So yeah, a lot of it's public.
Perfect. And what's a green flag specific to the property itself? The bricks and mortar that someone's going to be investing in?
Mm-hmm. I think specifications that match a target tenant. So if you're buying for young professionals, you want a layout that works for sharing, good sized bedrooms, even, double bedrooms, en suites, good communal spaces, that they're going to share. If you're buying for families, you want storage, outdoor space, a couple of good sized bedrooms. Again, you want it to be in proximity to good schools, that sort of thing. So the property, I think, has to be designed for who's actually going to live in it. And a lot of investor stock developments are designed to look great in a brochure, but they're not necessarily practical for the target tenant in that area or for that demographic.
Yeah, makes sense. And then red flags on the property itself.
Onerous lease terms, service charges that escalate sharply, ground rent doubling clauses. We've come across a lot in the last sort of 10 years. Mostly been legislated out now, but there are still cases of it appearing. And then, you've got short lease lengths on buildings. So if anything's below sort of 80 years, it can get a little bit more difficult and costly to renew and extend. And also mortgage lenders might shy away from it a little bit. And in new builds especially, cladding, big talking point over the last few years. We all know what happened at Grenfell, unfortunately, and it's still a live issue now. So you need to know the cladding status, on a building, on a development. You need an EWS1 form where relevant. And look, if the developer says it's fine, it's probably not. So yeah, look out for that documentation as and where you can.
Absolutely. And honest question, does any of this stuff actually get missed, or do most people catch it?
Yeah, missed all the time. I suppose main reason is the buyers, the investors, they trust the agent, they trust us, and they trust us to flag it. So if an agent's incentive is not always aligned, then, messages can get crossed, which is exactly where we go to next, I think.
Yes, Matt. So this one's the awkward one because we're an agency. So how do you differentiate between an agency that's actually working for you and one that's just trying to shift all their stock?
So the audience, everyone watching should, feel free to apply this test to us, by the way. Fair's fair. And I'm going to do this one in 3 things, I think. Yeah, 3 things. So do they tell you if a deal isn't right for you? A genuine partner will turn you away from property that's not a good fit for your goals. A salesperson will find a reason, for it to work for you.
And in all your experience in this industry, have you ever done that? Ever turned a client away from a deal?
Yes, absolutely. Plenty of times. I hear you guys, advising people in the right way all the time. I've done it myself. I've done it in previous jobs as well. And I think sometimes the deal's good, but it might be wrong for that person's actual strategy. Sometimes the timing's wrong. Sometimes the leverage doesn't work or stack up to their position. The point is that if every property you're shown is branded or said to you as it's perfect for you, then that's a red flag in itself for me, because no agent, no matter how big they are, has a portfolio where every deal suits every investor.
Second thing?
Transparency on fees and commissions, something that, we don't sort of hesitate. I don't hear you guys hesitate in telling people how we're paid. And I think that any investor should know exactly how their agent is paid and by who, and whether they're receiving anything from the developer. Because if the agency is being paid more by the developer to push a specific unit over another one, then their interests are not aligned with yours or with the investors. So ask the question directly, and anyone who gets evasive, red flag.
I mean, transparency, key ethos for us.
Absolutely.
And then thirdly?
After the purchase, so which we call post-completion. So what happens after you bought the property? A salesperson typically will disappear sometime after completion, maybe even the same day. A partner, which is what we want to be and which we like to show ourselves as. They're involved in the whole after sales process. They're involved in the lettings, the property management, past that, refinancing conversations, exit strategies, and that can be years later. Ask the agency, who's my point of contact now? Who's my point of contact next year? If they can't answer, you're a transaction, not a client, I'd probably say.
And just to touch upon that, what services do we offer that kind of show that we obviously want to build that long-term relationship with investors?
Yeah, it's not glamorous stuff. It's boring stuff, to be honest. So we, I suppose, first and headline thing is we won't list a deal unless we would go and buy it ourselves. I think that's probably the best thing to say. We have an internal SIF that knocks out a huge majority of what's brought to us, and we stay involved after completion. You have the same points of contact. You have ongoing portfolio reviews. We'll help you with the next purchase or the eventual sale of what you bought from us. And none that's glamorous, but it's what people like. And we had one just last week, haven't we? You had an investor who wants to buy something from us, but they've asked us to help sell what we bought them a few years ago. And that's something that we want to do. And those kind of that right advice helps compound a relationship over decades.
Absolutely, and it's over multiple investors. And then to summarise, green flags that people should look for in an agency.
So willingness to say no, transparency on incentives, long-term presence in the relationship, and a small one but tells you everything. They know the answers to the detailed questions that you're asking. They're not having to go and check with the developer every time. For me, real expertise is in the room with you or on the phone with you at the time.
Absolutely. So we're coming up on time. Matt, give us the 1 minute recap. Someone who's watching this, who's about to look at their next deal, what should they take away?
Can I do it in 4? Not minutes, 4 points. I'll get them into a minute. Probably get quicker than a minute. So let's think. Right. Location, number 1. Is the area's value being driven by something? Is it committed and real, or is it hype? The deal itself, do the numbers work conservatively when the real costs and the real rents are taken into consideration? So we'll highlight that net numbers rather than gross. The property itself and the developer. So is the building well designed for actual tenants? And does the developer have a good track record? Is it something we can verify? Us, the agency, and the investment consultant she's talking to, are they willing to walk away from a bad deal? If the answer is yes to all of those, then I think you're good to go.
Beautiful. I think that was just under a minute.
Okay.
And for anyone else watching who wants to take the next steps, what should they do?
So I'm going to give 2 options. So we're going 4, 3, 2. So 2 options. If you want to see sort of what opportunities look like through our framework, then you can book a call with myself or with one of our other investment consultants to go through what potential deals we've got now, and they'll be honest, as you always are, if they'll work. To do that, we've got to go through goals, we've got to go through our aspirations, what your position is, and as I say, we'll be honest about if it's the right time, right property, and if it's the right fit. No pitch deck, just a conversation.
And if people aren't ready to hear me talk to them just yet,
then we have an amazing thing called the City Club. So you can sign up to this. We send out deal breakdowns every couple of weeks where we apply the frameworks that we've spoken about. And these are real deals on real properties on the market. Even if you've never bought through us or not intending to buy, you'll get sharper at reading deals by this, and there's lots of other information that comes out with the City Club as well.
Perfect. Matt, thank you.
Thank you.
Everyone, thank you for joining us. Have we got any questions through from the audience? Not a problem. If you're watching and think of anything, feel free to get in touch, either call or drop us an email, and we'll see you in the next one.
Thank you.